Hello, welcome to the Economic View. I'm Tony Kaye. I'm joined as usual by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony.
Evan, early in the week we had the inflation data. We got caught up in that data, but there was some other interesting data that came out which really provided a real sort of macro lens on the Australian economy and where we're sitting. So thought we could talk about that today.
Yeah, and it's probably a good time to start looking at the macro picture, so not just individual pieces of economic data, but the macro picture 4 months in, basically, and where we sit, where 2018 is tracking and all that material behind it. So first thing I want to show you, this chart's from Morgan Stanley. It's an interesting one because it shows very clearly that if you look at those little sort of diamond dots, that's actually the Aussie's performance, the ASX that is, in US dollar terms versus global developed peers. And unfortunately, we are underperforming and quite dramatically so. The reason I want to show you that chart is because it sits down to the thematic that we've always spoken about over the last 6 to 8 months, which is that we are a value market, not a growth market. We have most of our index is defensive or value in nature, financials, staples, etc. And they have been a drag. You can't get past that. Look at what's happened to the big four banks, etc. So that explains quite clearly what's going on there. But, and getting back to your original question, is we are now having a scenario where the US 10-year has gone through the magical 3% mark, and everybody's been sort of leading up to this, and including myself. It's gone through it. Not only has it gone through it, it's kept going, so it's currently sitting at 3.05%. Highest has been in 4 years. The difference between the US and the Australian 10-year is now at some of the highest levels it's been in 19 years, and here's a chart on screen that's also quite interesting, which is from Bloomberg, that the difference is starting to really move up, and it's been quite interesting for the Aussie dollar. And this gets back down to the point, is that the Aussie is weakening because the difference, you can now actually, you have a very stable Aussie 10-year bond. We are not going to see rate changes. It's your question about inflation from us on Tuesday. The RBA has no reason to move rates, at least the next 12 months. It's the least likely central bank in the developed world to move rates either direction in the next 12 months. So it's very stable. So what's actually now happening is that for the first time in a long time, people are talking about and arguing that you can use the Aussie 10-year as a funding source. And what they mean by that is that you can borrow in Australia for, 2.8% was the last time I saw the 10-year. You can then take it to the US and get a difference at the moment of about 20 basis points. It's actually 25 if you take today, and make money, because you're also having to sell your Aussie dollars to go and buy US dollars to buy the US bond. So there's a trade there. There's an arbitrage trade, and that's a real interesting macro movement. There's also this orderly movement. Everybody's asking now, with the US bond going to the level that it is, does that make a scenario where you get disorderly trading? Do you get equity markets under pressure, et cetera, et cetera? You probably don't, because for the first time in a very long time, in fact, some people can't even see when this has happened in the past, is that if you look at valuations of asset classes as a whole, they're slightly all expensive. But that also begs the question is, if you were to take your money out of one of them and buy another, would you do that? Because there isn't this drag effect that, you'd normally get a scenario where equities look expensive, bonds look cheaper, and you move your money across, or vice versa, or into property, or what have you. They're all just slightly expensive. So you're not having this rush-on effect of one market under pressure, under theory, moving to another. So there's a lot of questions being asked about where markets sit, and they're all very easily poised. There's all reasons why, and certain parts of the market are certainly more attractive, but the macro environment is at a level that we haven't seen before, and it is because of the accommodation we've had from central banks. And that gets down to this original point that you asked me, which is, where do we see ourselves? Inflation is benign, growth is reasonable, probably below what people were forecasting. So there isn't any major events that I see anyway that are going to cause volatility, huge volatility, but it also means that we're going to get slightly malaised market trading as well.
And interesting to see that data showing where we're sitting at a time when the government's about to come out and announce the next budget, and will no doubt be wanting to sort of paint the picture that Australia's in a strong position and the economy is growing well. And we certainly are seeing elements of that anyway in terms of where money's being put in the economy.
Yeah, and that's a really good point. So the government still does have an argument that the economic growth in this country is reasonable. The last time we spoke about this last week was that the RBA in its minutes is believing that probably GDP is going to come in below its forecast, but it's still going to be growing at about 3%. Now that in the current world is pretty impressive. It's not shoot the lights out. I'm certainly not saying that, but it is reasonable. I mean, the US at the moment is growing at around about 2.5 to 2.7%. So we're technically growing slightly better. Europe's only growing at 1.3%. So take that with it. The other thing that's happened with the fact that the economic growth in this country, particularly back end of 2016, all through 2017, we know about employment, et cetera, and the growth that's brought with it. The tax revenue that the government's picked up has been astounding. So if you look at corporate expectations, so corporate tax collection is supposed to be increased by about $3 billion on the original forecast. Income tax pickup is about $2 billion. So you've got an improvement there of about 5. Then you've also got the improvement from things like commodity export tariff, et cetera. It's not a tariff, but a taxation on top of that, which they reckon will add another 3. So that's where you see this $8 billion improvement on the MyEFO scenario. So mid-year economic update, they will improve between $8 and $10 billion. And that's why yesterday you've heard about the fact that they're not going to implement the increase of the Medicare levy, so a 0.5 of 1% increase on top of the tax levy you already had to service the National Disability Insurance Scheme. That's already out. You know that. I can talk about that today. That is given. They've already announced that will happen. It means that depending on what band you're in, you're going to save between $100 to as much as $1,250 a year in tax savings. So there is a little bit of benefit of that. The other thing that is now being slightly rumoured and released is that the supposed tax cuts that we've also spoken about last week and the week before is that it will be a gradual thing. So it won't be an initial bang, we're going to cut your tax bracket from 32% down to 30% in the $87,000 earned. It'll be a gradual thing over a decade so that it's more sustainable, the budget will return to surplus, but at the same time you're not forking out the same amount. So the budget's very interesting. So they do have a good thing to sell. The question is whether or not it's a stimulant for the economy in terms of areas that need it. And that's the argument, which is why they're going to continue to talk about infrastructure. We've spoken about that before. That's the other thing that's been leaked is infrastructure spending will be up there. It is a job stimulator. It is a product stimulator. So that's the one thing to watch. And that may therefore improve our lines and our economic input and private return over the next forward estimates if they do go ahead with what's been rumoured.
All right, Evan, we'll leave it there for today.
Thanks, Tony.
Thanks for joining us on the Economic View.